I know SD Bullion has the lowest prices, but have you seen their price on 2015 Silver Eagles? SD Bullion has been selling them for $2.25 over spot, any quantity for months now. That's only 25 cents above mint cost. Why pay up to $3.69 over spot at AppMex, plus another 4% to use your credit card? SD Bullion's low credit card rate of only 3% means more silver for your stack. If you're still buying your Silver Eagles from the big boys who have offices on Wall Street, you're still paying up to 700% over mint cost more on Silver Eagle premiums you should be. Find out why nearly 15,000 new customers have made the switch to SDB. SD Bullion, the lowest price, period.
This is the Doc with the SD Weekly Metals and Markets Wrap. Joining me today as the guest host filling in for Eric is our good friend Craig Hemke of the TF Metals Report. It's great to have you back, my friend.
Hey, what's up, Doc?
Never gets old, never gets old. Well, it's been quite the week, to say the least, Craig. As we were just chatting before the show started, I think, unfortunately, we both saw this coming somewhat, just with the record amount of shorts the commercials had amassed in silver, and then breaking below some of the moving averages, and especially with gold, you could see it that they are getting ready to smash it under 1180 here on the jobs report today. Really, the last, what's it been, Wednesday, Thursday, Friday, the algos have been at work and they've been smashing the metals. Silver briefly peaked under 16 today. In my mind, gold has held up better than I had anticipated it would. It failed to break all the way down to 1150, which really I thought it would, and it still might Sunday night.
Yeah.
But I was expecting once 1180 gave away, it would likely trade pretty quickly down to 1150, but it didn't. It actually didn't even quite touch 1160, and as we finish out the access market here on Friday, it's recovering a bit here, up almost $10 off the lows.
Yeah.
But still, overall, it's been quite the week for the metals in another smash. So let's start with the trading action and get your take on that.
Well, it's frustrating to watch, I think, for most everybody, because so many folks now, through site like yours and site like mine, have figured out how the game is played. You know, this idea that the metals are some kind of free and fair market, when everything else is manipulated, but not the metals. That's the first thing that's such a folly to try to believe. But from just a traditional market sense, and I think we spoke about this maybe the last time I was on, Doc, what people don't understand about the way the futures markets are traded, particularly gold and silver, is it's completely different from the way, say, a stock, an equity would trade, in that in your average equity, I mean, just pick one, Coca-Cola, there's a float that's out there that's available theoretically to buy and sell on a daily basis. But it's a finite amount. I mean, there can always be secondary offerings that can be filed and more stock can be put out there, or you can do buybacks and take some stock off the market. But on a daily basis, there's kind of a finite amount. And so you've got finite amount of buyers and sellers as well. And so if news impacts things, if there's a fundamental change to the picture, for that company's prospects, then you're going to have either more buyers and sellers or more sellers and buyers, and price has to move up or down to reach some new equilibrium where buyers and sellers meet. But that's not how it works in the metals. When sentiment changes, when suddenly there's fundamentally important things happening, like earlier this year with the Swiss franc depegging from the euro, and everything that's going on in Greece, or whatever, all these different things that are going on. Anything that would drive futures traders, hedge funds, whatever, to take a position in COMEX traded paper, gold or silver, anything that drives them into that, they're not just chasing a finite amount of contracts. What happens are these bullion banks just simply create paper metal from thin air and issue new contracts. So rather than finding this equilibrium where buyers and sellers meet, you get a whole bunch of buyers, and these banks just simply flat issue brand new contracts to soak up that buying demand. And then it tamps down sentiment, it tamps down any momentum that might have come in. In doing so, then eventually the thing runs out of momentum, begins to peak. All the speculators that had just rushed in start to see that, oh, I guess we're not really getting our legs, and it starts rolling back over. And so then the speculators start to go back out of the market and start selling their positions. Then price gets maneuvered back below the certain key moving averages that kind of offered support on the way up. In silver, this week, a week ago, silver was still above its 50 and 100-day moving averages, about 1670. I told everyone on my side it's just inevitable until JP Morgan and everybody else rigs it below there to start the waterfall cascade of specs heading to the X's based on the technical signal of being below its 50-day moving average. It's exactly what happened. As soon as that happened, we fell, 70 cents in 2 days? And now all of the shorts that were created from thin air, added to the market by these banks 2 weeks ago, are in the process of being covered back up. And that's how it works. And it just drives me crazy that there are analysts out there that try to, look at the gold and silver markets in a traditional sense and say, well, you can't seem to get any legs here, and the dollar is going down, so gold should be going up. And since it's not, clearly it's a sign of nothing. It's a sign that HFT algos dominate the market is what it's a sign of. And, and lastly, I'll add one more thing that's just been really driving me crazy, because I get emails and people on my side all the time that, say some bullshit nonsense Elliott Wave chart reader is out there saying, that just because gold failed to exceed, 12.24 and 60 cents, that means that, clearly we're in wave 3 of down leg B of point A, whatever. And I'm thinking, if this I would temper my my language. If this guy had any idea how the markets worked, if the gold banks weren't issuing naked shorts to stop price before it got to 12.24.60, it would have gone through 12.24.60, and then your little wave count would have been all thrown off. And so, anyway, it just drives me crazy that people that don't understand how fundamentally different the pricing structure is for paper, gold, and silver. And we've seen it play out again this week. Like I said, we had all these specs that rushed into gold and silver, paper, gold, and silver 2 weeks ago. The cartel banks issued a whole bunch of new naked shorts. In some cases, in silver, they issued 11% of global mining supply. They sold short 11% of global mining supply in a week, all in an attempt to cap price, drive it back down. And now here we are at the end of that cycle. The specs have all been flushed back out, and we're probably ready to stabilize and start turning back higher. Sorry, Doc, I kind of monopolized your time on that one, but it put a quarter in me, and I'll just start talking.
So your thoughts are that it's more of a wash, rinse, and repeat cycle than an event where we're potentially looking at a final big smash down, maybe early next week or on Sunday's Globex Open?
There's a reason. I don't know how much time we want to take talking about this stuff, but back in November, the linked algorithmic trading between shorting the yen and shorting gold at the same time that has dominated the paper gold futures market now for 3 years. As the yen was falling through the fall, the computer shorters, the HFT computer shorters of the yen also were shorting gold and drove gold all the way down to 11.35 or 40, whatever it was, in early November, and just about broke the physical market in London. Historically low GOFO rates, negative GOFO rates, were indicative of that. Ever since then, whenever price has come back down to 11.50 or anywhere near it, it has bounced. You could even say that maybe the banks aren't letting it go any lower than that because they don't want to put themselves in jeopardy again with being unable to find gold at those prices. And so therefore, I don't think, maybe they'll try to jam it down a little bit further. There's probably still some spec longs in gold that could get washed out, which would allow the gold banks to cover even more shorts. But from a historical basis, that COT structure in gold isn't extreme at all. We just got a COT report this afternoon that showed from a historical basis we're far more bullish structure than a bearish structure. The fact that price reversed today at 1160, we're talking about that earlier this week at my site. A lot of chart support between 1160 and 70s. The fact we reversed off of that today and actually, as you said, are back about maybe 1171 as you and I speak here late Friday afternoon. It's not surprising. They may try to work it a little bit lower, but I warned everybody yesterday. I thought today would probably present some kind of a tradable, if you're into that kind of thing, tradable opportunity somewhere below 1170 and below $16 in silver. And so far that's worked out. And they may mess with it still a little bit early next week, but I don't think they can really work it appreciably lower from here. And we're probably now just going to go sideways until the next wash part of the cycle begins and the specs go back into the long side and price goes back up, and and it's just a repeat of January, end of May.
As we speak here Friday afternoon, Craig, the Greek crisis and situation, Greece is getting flushed by the minute and nearing an end game almost by the minute here. Really in the past 24 hours, reports are that the Greeks have pulled about €1 billion from their banking system. What's your thoughts on really this week's takedown of the metals? Think there's any relation to that with the bankers trying to knock down the metals ahead of what could be fallout from the Greek crisis?
I think in the end, Doc, the bankers were just happy to see the continued weakness brought about by selling of these high-frequency trading speculator algorithms. I mean, they paraded into long gold a couple of weeks ago. Once price was rigged back down below 1220, and then it was rigged below the 200-day, and it was rigged below the 100-day, and it was rigged below the 50-day. Now those same spec algos are rapidly moving back out of their longs and going short. Into all that selling, the banks are buying and covering all of those shorts that they issued 3 weeks ago. So I think they're happy to do that. What's happening, again, this just shows you the fundamental disconnect from reality that we have in so many markets today. Because on a fundamental basis, you look at what's going on in Greece and the very real risk of Greek default, exit from the euro, leading to the eventual exit from by other countries from the euro, leading to a complete dissolution of the euro, perhaps, right? And credit collapse and credit default swaps and liquidity collapse and all these things that go with it. You should look at that and go, holy cow, how fundamentally bullish is that for gold? It should be going up, right? That's what everybody thinks. But see, that's in this world of high frequency trading, that's not how it works. Everything's done by computer.
Yeah, and the computers, first thing they'll do is, buck's going up, so dump everything else.
Exactly. And specific to gold, it's not even the euro that matters. It's the yen that matters. But nonetheless, computers see the dollar going up. Why is the dollar going up? Not for any real fundamental reason, just as the euro is going down, right? Because, hey, the euro might be breaking apart. So the euro goes down, dollar goes up. The computers are programmed to trade off of that. And so they sell paper gold. And that's now all of a sudden it puts the banks in a bit of a bind if I've been reading this correctly for the last 7 or 8 months, because again, at or below 1150, it seemed that they had a real problem sourcing physical metal to deliver in London at that price. And it still seems that way. It still seems as if, and I talked to Andy McGuire about this a couple weeks ago, that these banks are living off of flow, that the stock, the available stock, that they're able to, take some from here and some unallocated from here and re-register here and ship it and borrow it and rehypothecate it. All that stock has dwindled down to next to nothing. That's the whole thing that we've talked about so many times of Ken Hoffman from Bloomberg a year and a half ago talking about the vaults being empty. These big vaults. These
unallocated. Back after Venezuela's gold that Venezuela repatriated, 2 years ago?
Exactly. I mean, they're doing everything they can to scrape it up. They're still rating the GLD. The GLD is now down for the year. It's actually down after price bottomed in late June 2 years ago at 1180, which is basically where we are now. Price is unchanged for the last 2 years. The GLD is still shed another 200 and whatever it is, 260 metric tons of gold. I mean, they're looking for it every place they can get it. And okay, so anyway, so the bankers, in a sense, kind of become our friend. And I know that's kind of, what an odd thing for Turd Ferguson to say, but they are the ones, when price gets down to 1150, that are keeping the computer algorithms that are selling gold with every downtick in the yen. They're the ones that are keeping the computer algorithms from driving it to 1050 or driving it to 950. Again, we saw that correlation break back in November. The yen looks terrible on the chart. I mean, the yen could go to, dollar yen could go to 135, 150. I mean, it looks terrible. If that's the case, Normally, the computers that have, these HFTs that have linked them all together, you think, God, they could drive gold down to 950. But if there's no physical gold to deliver sub 1150, it ain't going to happen. So that's what I mean. The banks could ultimately kind of be our friend because they don't want, for their own sake, they can't, they risk default and unable to deliver. So they go in there and start buying against all of these computers that are selling is conceivably basically what happens when we get down this low. So anyway, hopefully that continues to provides a floor for price.
Yeah, and I can certainly substantiate those statements on what demand would do if gold would break down below 1150, really at the levels we've seen over the past day or two, and silver's not even at its lows from 5-6 months ago, and gold's still $30 off the lows. And I mean, in the past 24 hours at SD Bullion, and I mean, we're not even anywhere near one of the big boys. I mean, we're just a small to medium-sized bullion dealer. We've burned through about 40 or 50,000 ounces of silver and maybe 600 ounces of gold. I mean, you're talking probably 2 weeks of normal volume, really, in the past 24 hours with prices where they're at right now. And if you did see gold break below 1150 and go anywhere near 1,000, and if silver were to go anywhere near 14, there wouldn't be any physical to find on the retail side. And
yeah.
London's really no different from everything we can tell. Conveniently, they're not publishing GOFO anymore, but from everything we can tell, London's no different.
Right, and who's going to mine it at those prices? That's not a coincidence either. I mean, we talk about the gold chart finding a physical floor at 1150, but you can see the same thing in the silver chart at about 1550. I mean, today we stopped. If you draw a trend line from the March 17 lows and connect it with the lows back at the end of April, today we stopped just above that trend line. But even if we were to break down, again, you're in a sense compressing on a spring because if there's no physical metal to deliver at the paper price, then the paper price loses all legitimacy. And the banks don't want that because they control it through the paper price. They've done that since January 1, 1975 when they introduced COMEX metal futures.
Craig,
so
did you see the story this week along those lines? It was out of South Africa, and I'm drawing a blank now where I saw it, but one of the officials in South Africa was warning that their production is declining so rapidly that they may not have a gold mining industry by 2020.
Yeah. See, there you go. I mean, so this is what drives me crazy is you get these, Elliott Wave goofballs that sit there and say, based on some weird, look in their little magic 8-ball, that silver is going to go to 8.
Right.
I'm like, what?
And look at other examples. I mean, that's what was going on in the auto market in 2008 when people were saying like, oh, Detroit's going out of business and they'll never produce cars again. I mean, to me, that's a telltale sign.
But no question about it. And again, there are certain fundamentals that do actually eventually force themselves to the top of your screen. And those are some of them. And so, again, with the recent action, there's always going to be people. I mean, every time gold goes back below 1,200, people come out of the woodwork. Oh, it's going to 950 now. Okay. It could if the yen's going to go totally in the toilet. And because of that, all these high frequency trading algorithms that short gold and short yen at the same time, if they're able to drive gold then down to 950, and if the cartel banks are somehow able to find the gold to deliver at 950, then okay, you know what, it's going to go to 950. But those three things all coming together, I just don't think it's going to happen. If anything, just because they haven't been able to source gold below 1150. Right. So unless, they talk the poor, foolish people of Venezuela into leasing back 40 tons or whatever it is, but it's 40 tons, which is a lot to you and me. But in a world where, just this week, Russia announced they're going to add 400 tons over the next few years. So 40 tons is, nothing. So I feel pretty good. It's frustrating. It's really hard to watch. And the amount of analysis, so-called analysis put out there by people that have no idea what they're talking about when it comes to gold and silver and how the physical and paper markets operate together. It's enough to drive you crazy. But at the end of the day, it just continues to present opportunities for guys like you and me and everybody listening that recognize that at this is just a big game of charades, a big game of musical chairs that's all going to end sometime. And we just need to keep using this time and this price weakness to our advantage to prepare for the way the world's going to be changing in the years ahead.
And when you look at sentiment, it really has been a war of attrition
Yeah.
makers have been waging. And I go back to something that Jim Sinclair warned people about probably a decade ago and repeatedly warned people about, is that the hardest thing in a bull market is to be right and sit tight through it throughout the entire bull market. And we can see that, we were kind of chatting before the show, we can see that in the blogosphere, in our markets, we can see it in customers we talk to. As I was remarking a little bit ago about the massive increase in demand we've seen, it's really been disproportionately skewed to larger investors. It just really seems to me, from what I'm seeing anyways, is that the average Joe, the guy who's making just enough to get by, he doesn't have a house in the Hamptons and three condos in Florida or something, and buys maybe a tube a week or a tube a month. He's disillusioned, and he's sick of it.
Right. No, and understandably so. And the same thing's been true at my site. I mean, ever since that rally that began the year that was so brutally capped, I mean, the gold cartel banks issued 54,000 naked shorts in 2 weeks back in January to stall the rally and to roll it back over before it, really got too extended. I think that one really put a lot of folks' fire out. I've seen my traffic, my site's down by 15-20%, I suppose, since then. And it, I can't blame people for saying, you know what, hell with this. I'll check back in on gold and silver. I'll check back in on TF Metals Report, or wherever.
And we're not talking about Bull Pony here. We're talking about an analyst who's been probably more right than anybody in our sphere, from what I read.
Thank you. And it is, but it just is what it is, and it's human nature. And I think folks are just, it's just to wear you out, no question about it. And and that's perfectly fine. I mean, as long as people aren't stupid enough to say, you know what, I think I'm going to take all that gold and silver I bought and convert it back to dollars, because dollar is a place to be. As long as they're not doing that, hell, they're welcome back. They're certainly welcome back to my site and yours anytime. But I can certainly understand where it's frustrating. And, you mentioned the average guy getting, just being frustrated and not being pulled in all these different directions anyway by aging parents and tuition costs and everything else. I'll just throw one more thing at you. I just posted to my site this afternoon a column that Jim Quinn wrote at his site, The Burning Platform, earlier today. And Jim Quinn is just great. And that's a wonderful site. He just does such a great job. But here we are today. Everybody's talking about what I call the BLSBS, the NFP number. We had 280,000 jobs, oh, hey, and then Leisman, is waving his arms around like everything's the greatest thing in the world.
Green shoots. Jim Quinn points out that over the last year, if you combine the total age bracket, the demographic group of 35 to 54-year-olds here in the U.S., okay, that's a big group of people. These are the folks that are having kids, getting married, buying a house. And then as you get older, you're getting into your peak earning years, your peak saving years, your peak spending years. The age group 35 to 54 over the last 12 months has added 117,000 jobs in the last year. That is 1.7% of all total new jobs added. I mean, that tells you about everything you need to know. I mean, the jobs that they're all so excited about are either make-believe birth-death adjustment model jobs, or they're, part-time. Or they call you an entrepreneur if you got laid off and now you're mowing lawns, and that kind of stuff to try to make some extra money because you can't find a job. I mean, it's sick what they attempt to do, how they distort the data to their own means. And again, I can't blame people for being sick and tired and frustrated, and being told that everything's fine when it's not. But it's the world we live in, and it's not going to be this way forever. And that's what gets us back to our main message. I know it's yours too, which is just to
keep your wits about you, be aware of what's really happening, be what we call situationally aware, and be using this time still to prepare for changes that are coming in our lifetime, that's for sure.
I mean, it's just all ridiculous propaganda. Like you said, BLBS is really the right description for it. And they piggyback on it. Not only do they come out with that bogus number, but then an hour later, the New York Fed's Bill Dudley comes out and chimes in that, rate hikes are still on for 2015.
Yeah. I think an interesting point of discussion, and there have been a few times we've had this on my site, is what are the Fed's real intentions? Because, I mean, keeping in mind that the Fed is a private corporation owned by banks for the banks, right? So therefore, it's pretty safe to assume that their real intentions are not to benefit the average American. Their first and foremost goal is to benefit the people that own them, the rest of the banks. And so when the banks were basically in default and insolvent in 2008, what'd they do? They come up with QE, print money out of thin air, devalue it for everybody else, but use that money to buy all this crappy paper from the banks and give them fresh Fed cash off the balance sheet instead. I mean, that stuff is worth 1, 2, 3 cents on the dollar, and the Fed's buying it from the banks at 100 cents on the dollar, removing it to their books and giving the banks cash instead. And now the banks have no one's ever been prosecuted. All the banks are reporting record profits, all record bonuses, all this kind of stuff. And now, with the banks fully flushed with cash, the Fed decides they can raise rates. What? Again, it makes you wonder, what are their motives? What are their actual intentions? And I think that's a justifiable thing to discuss because to me, it's pretty clear. They're looking out for themselves and their member banks first. And anybody else
and second, third,
beyond
fourth,
that.
fifth.
And second and third. Everything else is tertiary and beyond that. No question in my mind.
All right, well, transitioning a little bit here before we wrap up the show, Craig, we'd also be remiss if we didn't discuss the Ukrainian situation because that seems to have reared its ugly head and popped back into focus here this week.
I tell you what, Doc, this is some scary, scary stuff. We at TF Metals Report have been on this story like ugly on an ape now for almost 2 years. Since before the Maidan thing, the whole coup took off in early 2014. I post every week the weekly discussions on the John Batchelor program between John Batchelor and one of the most renowned, respected Russian history experts in the U.S. by the name of Stephen Cohen. And I feel like in the last year and a half, I've taken a Russian history course. I'm perfectly comfortable discussing this issue with about anybody at this point because I feel like I've been through it. Like I just got my graduate degree in Russian history and Russian studies. This is a really scary situation. The West is kind of playing football with it. Obama, and the neocons, if you want to call them that, of the West, for really since the wall came down, have been pushing to expand ostensibly NATO, but Western influence. And Ukraine has been the jewel in their eye for quite some time. And Russia sees that because of their long-held alliances there. And I mean, they share common family bonds, common language, all that stuff. They see Ukraine as an existential threat to Russia. There was a lot of talk back in January, well, even last year, but it really started to peak in January and February, that John McCain and all these others in Congress wanted to arm with offensive lethal weapons the junta in Kiev and the Kiev National Guard and the Azov Battalion and all these bad fascist guys. And the only thing that stopped that from happening were these Minsk peace accords. If you remember, all of a sudden, at a real critical hour, all of a sudden Merkel was just racking up the frequent flyer miles. She went to Moscow, she went to Paris, she flew over, talked to Obama, flew back to Moscow, and they came up with these peace accords that held for about 90 days and have been slowly, systematically dismantled, not by Russia, but by the government forces in Kiev. And now this week, hot fighting has broken out again. This is, I can't state it strongly enough, and I'm not trying to be hyperbolic. This is seriously scary stuff. This is Cuban Missile Crisis level stuff that I didn't live through. It was 4 years before I was born. But as this heats up again, if it gets worse, you're going to get more and more calls out of the war party in Washington and out of Brussels to arm and to send troops to Ukraine. And that's only going to cause Russia to counteract to that. And the thing could ramp up and get really scary really fast. And boy, if you think anybody listening to this has thought, well, I thought that was fixed, it's not on the front page of the paper anymore. You really need to be paying attention to what's going on over there. You could say this doesn't have anything to do with gold and silver, but it does. Maybe that's a topic for another day. But please, everybody, please pay attention to what's happening in Eastern Europe. It is some scary stuff and could really get nasty as we go through the summer.
Tie in with that, and maybe to help us end it here on a little bit lighter note.
Nothing but some sunshine from old Craig on a Friday afternoon.
Right. I'm not anything of a soccer fan. Those who know me, I can't stand the sport. I'm not a footballer. So when the whole FIFA scandal broke a week or so ago, I kind of just rolled my eyes. I didn't even look into it. My comment to a buddy was they must not have stolen enough like the bankers do. And then I think yesterday, I don't know where I was reading, but somehow I saw the 2018 World Cup in Moscow, and I just burst out laughing.
It became clear to you what's going on, didn't it?
I mean, that's all I had to hear was the 2018 World Cup was in Russia, and that explains everything.
Yep, they're doing everything they can now even the FBI is investigating it. That's what this is about. They want to further humiliate.
What it's about. I mean, it's not a problem to take $500 million in bribes as long as you're awarding the World Cup to South Africa or Brazil or any place that Putin doesn't reside.
Right. Well, and since, while we're on it, and just to take an extra minute, this is why I started following this so closely a year and a half ago, because this is very much about the end of the great Keynesian experiment, as we call it. The U.S. has acted all along like it had the high hand at the table, that it controlled the way events were going to go, and that it could, make Russia bow and take a knee. And which is nothing could be further from the truth. I'm not trying to say I'm some kind of Russian Putin fan, but clearly as a creditor nation and now working with such close alliance with China and India and the others, all we've done in our attempts to isolate them is exacerbate and increase the speed at which the world's going to be changing. I mean, China themselves, what was it, about 2 months ago, there was a forum held in Rome all about China and internationalizing the renminbi. And the guy who's the chief economist of the Bank of China, not the People's Bank of China, but the Bank of China, okay, the largest commercial bank in China. Again, this is not just some banker in a suit. I mean, this guy's clearly got to be pretty well connected to the Politburo and the big shots in Beijing to get a job like that. And this guy says that this has been a plan to internationalize the renminbi, make it, if not the reserve currency, a reserve currency. It's been a plan they've been working on for decades, and now it has sped up. And this guy even said it will be ready before the year 2020. So, I mean, this is all happening. The way we tried to isolate Russia was only made it worse, only made it move faster. Look at that big gas pipeline deal that they finally finalized with the Chinese a few months back that they've been talking about for 10 years.
And us trying to kick them out of the SWIFT system. Okay,
yeah.
We'll create our own alternative SWIFT system.
Exactly. That's what's so foolhardy about all of this stuff.
Didn't see that coming?
Yeah. Well, that's what's so foolhardy about all this stuff. But you've got this, this war party that, just wants to keep pushing the envelope, and whether they want to do it from a Keynesian sense, nothing like pumping up GDP like a war. But anyway, they've really backed themselves into a corner on Ukraine, and this restart of open hostilities is really bad news, because this situation could get out of control really quickly, and the rhetoric's going to ramp up. And if Obama gets forced into and wants to supply arms and not just trainers, but actual troops to Ukraine, I don't even like to think about where this could all lead. So on that happy note, maybe we should just go get a beer, Doc, and call it a week.
On that happy note, we'll wrap the show. So
you got it, my friend. You're right now, you're going, God, I got to get Eric back next week. This sucks.
No, I was looking forward to having you on this week, especially with all the trading action we had and the metals nearing their lows. So it's encouraging to hear your take that you think will soon be headed higher on the whims of the bankers themselves.
Yeah, or at least not headed lower on the whims of the bankers themselves. And I think that's an important takeaway, because there are probably even still people out there, I'm not counter told me it's going to 950. Well, it ain't going to 950. So recognize the connection between the paper and physical market that has to exist. And then, let's expect this latest cycle, the spec cycle of trading in and then getting fleeced back out has about run its course. And so now we'll probably trade sideways again and creep higher. And then, maybe later on this summer, look to mount a rally again.
All right. Craig Hemke of TF Metals Report. Check out his subscription service. We'll have a link in the write-up. It's tfmetalsreport.com, I think, /free trial, where they can find out about it.
You can get a 2-week free trial just to check it all out. You don't even need to give a credit card or anything like that. And then if you do want to stick around afterwards, it'll cost you a whopping 33 cents a day. It's $10 a month.
All right. Highly recommended as always. So
thanks, Doc.
It's great to have you back.
My pleasure. I hope you're able to have a relaxing weekend.
For the Doc and Craig Hemke, thanks for tuning in to this week's SD Weekly Metals and Markets.